This playground behind me looks like a spider's web. For many years, Tesla has seen as a spider eating the rest of the industry caught in its web. Tesla had innovative products and rewarded long-term shareholders well. Yet in 2022, Tesla stock was down 70%. Some are now wondering, is Tesla a smaller spider waiting to be eaten by other larger spiders? Or is this spider spending more time in a bird's nest? Tesla just announced their Q4 delivery report, delivering 405,000 cars in the quarter for a total of 1.3 million cars delivered in 2022. This is 40% year-on-year growth. Really impressive results in a recession year when the rest of the car industry is down by 8%. Yet, many Tesla investors are disappointed. In a recent poll, most of you shared that you are disappointed and expected better results. In this video, I'll share the reasons for the mixed reactions and what this means for Tesla investors. Click subscribe to stay updated to more videos on Tesla. Let's start with why some Tesla investors felt stung by a bee and were disappointed by the results. Deliveries missed Wall Street consensus of 418,000 deliveries for the quarter. This is largely driven by the understanding that Tesla should be growing 50% year-on-year. In Tesla's quarterly earnings, Tesla's leadership team has said a few times that they expect 50% year-on-year growth in the foreseeable future. The nuance is that this is an average over time and not a commitment for every single year. I believe Tesla could have done a better job managing expectations. Many Tesla investors, myself included, expected Tesla to make at least 420 deliveries for the quarter, even as Tesla shifts away from quarter-end delivery waves with more vehicles in transit. While Elon has shared that he's been present in every major Tesla meeting recently, there's a growing perception among Tesla investors that his focus is shifting more towards Twitter, without a strong second-in-command running Tesla. Adding fuel to this perception, Elon's work on Twitter is by nature very public, while Elon's work on Tesla can sometimes happen behind the scenes. Just like how SpaceX has a great COO with Gwynne Shotwell, many Tesla investors hope that Tesla could have also a strong COO, maybe someone like Tom Zhu, who used to be the president for Tesla Asia Pacific. There are recent news that he's taken on a role managing sales for North America right now. With Tesla stock price down 70% and car demand weakening in a recession, investors fairly expect Tesla CEO to be more hands-on during these tough times. Koguan, Tesla's third largest retail investor, recently advocated for the same. Stepping back from short-term sentiments and looking at Tesla's fundamentals, Tesla has grown from a vulnerable caterpillar that could be eaten anytime and has morphed into a capable butterfly soaring high above the rest of the industry. No other large cap company is growing as fast as Tesla at 40% year-on-year. Apple is growing 8% year-on-year and Microsoft is growing 18% year-on-year. On top of that, there's no other large cap company with Tesla's growth headroom. Tesla only has 3% of the global car market of 1.5 billion cars. If we look at annual compounded growth since 2020, Tesla has still exceeded the guidance of 50% average growth rate, delivering 62% growth so far. Other car companies like Honda saw a 30% decline in sales in 2022, and Volkswagen saw a 23% decline in sales in the first half of 2022 due to supply constraints and also lower demand. Tesla's industry-leading margins will be an important lever to help Tesla maintain profitable growth in 2023. In China, Tesla is running a Lunar New Year promotion, keeping car prices at last year's subsidy levels, while BYD had to raise prices after the subsidy ended. Tesla is able to do this because Tesla makes 8 times more profits per vehicle sold compared to BYD. Lower car prices means more EVs will be sold. For those who believe in Tesla's mission, Tesla managed to take away up to 1.3 million ICE cars from the roads last year. 97% of the world's cars are still running on internal combustion engine. What does this mean for Tesla investors? Many Tesla investors are shaken after Tesla's stock price free fall, like this slide next to me, last year. To build investor confidence, Tesla is holding its first ever Tesla Investor Day, a different event from its annual shareholder meeting on 1st March in Giga, Texas. In this event, Tesla is going to go through its long-term expansion plans, probably announcing its new Gigafactory location. It will share its third-generation car platform in more detail, and it will talk about its capital allocation plans. I believe in this event, they will share their long-term plans for a stock buyback program. Many of us have seen large declines in our stock portfolio. My own stock portfolio is down 37% since inception, with Tesla stock price now at 34 price-earning ratio, down 32 times from its peak of 1100 in December 2020. Some see this as a good buying opportunity, while many others think it's insane to buy Tesla stock now when its price could still drop further in the short term. Some have timed the market well. If you followed Chicken Genius, you not only avoided losses but potentially even made profits during these tough times. For myself, I will continue the dollar cost average. And I'm underperforming the market now, yes, but I believe underperforming at times is a feature and not a bug of dollar cost averaging. There will be years when I underperform, there will be years when I overperform. For me, by 2030, if my average annual rate of return is about 20%, that's a win for me. I don't need the highest investment return, and Tesla is a company I deeply believe in. I believe that all of us should remove our use of margin in these tough times to build up our cash reserves and stay safe. If you found this video useful, please click the like button. Hit subscribe to stay updated to more videos on Tesla.